Good afternoon. This is Madeline Henry from Oxford Economics. Can I start by welcoming you all and thank you for joining the Oxford Economics webinar on Latin America in 2015, Fighting Complacency and Mediocrity. For those of you who are new to Oxford Economics, as a brief introduction, we were founded in 1981 as a commercial venture with Oxford University and are now one of the world's leading independent global forecast and advisory firms, providing analytical tools, forecasts and reports on 200 countries, 100 industries and 3,000 cities. Before we get started, just a few housekeeping points. Ariane Vazquez and Marcos Casarin will provide a 20-minute presentation and we will be taking questions. If you would like to ask a question, there should be a drop-down box at the top of your screen. Please use the chat icon that is in the top-down box and send a private message to the host, Adrienne. This can be done throughout the presentation. That's all from me. I'm now going to pass over to Ariane.
Good afternoon, those on the other side of the pond. We thank you for joining our call today. My name is Ariane Vazquez. I am the senior EM economist here at Oxford Economics, and I'm joined today by Marcos Casarin, our LatAm economist from out of our London office. And together we'll be providing you with some perspective on the LatAm outlook for 2015. The last time we met was back in July, and in the past couple of months we've evidenced some noted changes across the LatAm outlook and across the global economy for that matter. For the region as a whole, 2014, as you will see, was particularly difficult, and we're entering 2015 with some noted challenges, some risks, and some important concerns that Marcos will speak about shortly. On top of that, conditions across the global economy remain incredibly delicate and uncertain. For one, the global growth outlook remains rather uneven, somewhat fractured, less tethered. The U.S., by all means, is in recovery mode, as we saw from the payroll numbers today. But China is slowing, the EU remains in disarray, and the emerging markets' economic activity across the EMs has remained rather subpar. Secondly, we're dealing with a global economy that is in the midst of shifting global policy dynamics that point to major divergences and differentiation. And lastly, the ongoing shifts in global growth and international policy dynamics are bearing important repercussions across the global commodities market, spurring volatility across the regional financial markets and challenging policymakers across the world in their efforts to balance private market demands with public and social obligations. So what we'll do in the next 20-25 minutes is discuss the LatAm regional outlook for 2015, emphasizing some of the key macroeconomic drivers across a select number of countries, and then we'll briefly discuss some of the major challenges and concerns, talk a little bit about some of the markets and strategic positioning into 2015, and then we'll certainly open it up to some Q&A. So with that, I'll turn it over to Marcos to lead the discussion on the outlook.
Thank you very much, Ariane. So basically, let's get started talking about 2014 and then how do we enter 2015. So 2014 will be probably seen as a lost year for the whole Latin America, and 2015 will be only a little bit better, not much. Save for Mexico, Colombia, and Peru, growth in 2015 will remain pretty much below potential in Latin America as a region. On top of that, we have the recent slide in Latin American currencies, which is quickly feeding through to higher consumer price inflation, which is more than offsetting lower commodity prices that we saw over the last couple of months. So it's a region that enters 2015 with growth below potential and inflation above targets, a slightly complicated combination for the region as a whole. Moreover, lower commodity prices will prove challenging for some Latin American economies. Let's highlight Venezuela here, which exports 96% of their exports are oil. So Venezuela will have to navigate in choppy waters in 2015 and beyond. We'll keep an eye on that. More on the commodities, more generally, just aside from oil, if we saw concentration of exports into commodities during the last decade for the whole of LatAm due to increased Chinese demand in the commodity supercycle, as it's called, in the next decade, Latin American economies will have to diversify. So there'll have to be an effort from governments and also from private sector institutions to diversify growth away from commodities. And lastly, on the strategy side, despite a gloomy outlook, we see some opportunities in local markets and also in external debt. Ariam will dive into it in more detail by the end of the presentation. Just to give you a flavor on the performance of Latin American assets in 2014, these two charts show currencies on the left-hand side and equities in local currency on the right-hand side, the year-to-date variation. It's pretty much all the red countries are Latin American countries and the blue countries are other key emerging markets. So as you can see, Latin America is pretty much at the bottom of the list in both of them. So it was not a great year for LatAm. So let me kick off with the outlook for 2015. So this chart on the right-hand side, what it shows that the key message here is that Latin America is going to continue to underperform the world economy. So you have the world economy in light blue, Latin America in red. Basically, over the last decade, boosted by demand for commodities, Latin America outperformed the world economy. There was a little bit of a catch-up process going on into 2004-2013. But then in 2014, Latin America performed rather sluggishly, and then 2015 will be no different. We estimate growth at 1.3% for Latin America this year. This is half of what we expected in January. And who are the culprits? Well, basically, we downgraded all Latin American countries across over 2014. So since January, we downgraded pretty much everyone. So for 2015, what's the story? Well, the story is a story of divergence. I particularly like this chart because it shows our GDP growth forecast broken down by the countries we follow the most here at Oxford Economics. And as you can see, the red bar is the Latin America growth as a region, and then you can see a clear split between countries that are facing the Pacific Ocean and countries that are facing the Atlantic Ocean. So the Pacific countries are the outperformers. So you have Peru leading the pack, Colombia, Mexico, and Chile. And then you have the likes of Argentina, Brazil, and Venezuela. A point that needs to be made here is that Argentina is posting positive growth in 2015, but that's based on official data, which remains highly suspicious. Right, so let's talk a little bit about inflation here. Among all the countries that have inflation targeted regimes in the region, all of them at the moment have inflation above the target. That despite sluggish GDP growth. It's no news that Brazil inflation is above the target for quite a while, and even the well-managed Chile having inflation at the moment above 5%. For next year, we expect inflation to remain under pressure. This is because we have commodities, we have commodity prices that are exerting downward pressure, but at the same time, we have these countries' exchange rate depreciating. So it's going to be difficult to have a substantial decline in inflation across the region, and that leads to some divergent monetary policy dynamics. So against a backdrop of high inflation and slowing economies, the outlook for monetary policy is pretty divergent. So Brazil should continue hiking up to 12.25%, which we expect the central bank to end the tightening cycle in March next year. Colombia should resume the tightening cycle in a bid to bring growth towards potential. So we see rates at 5.5% in the second half of next year. And then you have the likes of Mexico, Peru, and Chile, which should start to tighten policy only by the end of the year. In terms of external position, well, this is a chart that compares the current account deficit with the inflows of FDI. So FDI is pretty much the most secure way to finance external debt, external obligations. So what we can see from this chart is our main concern is Brazil. So we have Brazil with a current account deficit forecast at 4% of GDP, with inflows of FDI of only 3.1% of GDP. So it's almost a full percentage point that Brazil needs to fund itself with hot money, with portfolio inflows. So what matters for us here is that leaves Brazil still pretty vulnerable to a change in investors' risk appetite. So we should keep an eye on that. On the other countries, funding for the current account deficit, it still remains pretty comfortable. We have Chile very comfortable, Peru still fine, and then even Argentina is a country that struggles to attract FDI inflows. The government is pretty much trying to overcome that by restricting imports. So their requirement for external funding is pretty low because they are restricting imports to avoid a shortage of dollars. In terms of fiscal policy, I think the only country here we should worry again is, surprise, surprise, Brazil. So if you look at the chart on the right-hand side, Brazil's got the highest debt to GDP ratio. And if you look on the chart on the left, Brazil also has the worst fiscal balance position. 2014 was a particularly difficult year for the fiscal side in Brazil. We expect some tightening into 2015 onwards, although we remain pretty skeptical about the capacity of the government to execute its medium-term fiscal consolidation plan. We'll keep an eye on that. Our forecast, our baseline forecast, remains similar to the new target set by the government, which is a good sign. But we'll keep an eye because it may be that they miss the target again. So I'm going to hand over to Ariam, and he's going to talk about the risks, the challenges, and the concerns for the region.
All right, thanks a lot, Marcos. So for LatAm and probably the entire emerging market universe, the key focus next year is certainly on the U.S. Fed and on China. And these two factors will without a doubt be the principal elements driving the regional outlook. I'm not going to delve deep into the trade, capital, and credit links between LatAm and China, but it's obvious that for LatAm and the world economy for that matter, the principal threats stem from a deeper than expected deceleration in the Chinese economy, let alone that of a major policy mishap in China. The Chinese economy is in the midst of an important economic rebalancing, driven by a very deliberate approach to generate lower but more sustainable levels of economic activity. And these efforts not only implied major adjustments to reducing the country's dependency on external demand and investment and generating more sustainable sources of domestic demand and private consumption, but they carry important adjustments to key drivers of economic activity in the real estate sector, the financial sector, the state-owned lending, and so forth. And this policy recalibration effort speaks to internationalizing the currency, opening the capital accounts, liberalizing interest rate regime. So these are all very deep adjustments that are taking place, and for all intents and purposes, you have the Chinese economy in a very deliberate economic growth deceleration with major policy changes, and you know, we're not of the view that there's going to be a major policy mishap, but it's important to keep an eye on, and without a doubt, I think a slower growing China certainly has an impact on LatAm because the deep synergies that you see between the two regions. The other key endeavor is obviously that of the normalization of U.S. monetary policy. You know, we just look at all the outright volatility and anxiety that such manifestations by the U.S. Fed caused this year, and now we remain of the view that that the Fed is poised for its first rate hike in the second quarter of 2015. It's important that to remember though that this is still a Fed with very clearly dovish tendencies. And despite speculation and interpretation that the Fed may be too slow to act, the last thing the U.S. Central Bank wants to do is to derail a very nascent recovery. I know we got very good job numbers today, but the reality is that wage pressure has remained very subdued. Inflation is, for all intents and purposes, not very existent. So, you know, we were the Fed, while they're going to hike, and we target a Q2 2015 rate hike, for all intents and purposes, they're probably going to move in a very gradual and cautious approach to really not derail this recovery. So with that, we'll go over to the next slide. So what we've been heavily engaged in recent months is modeling of these potential impact scenarios on the LatAm region. And we talked about China, we talked about the Fed, but there are also a number of threats that exist in the global economy, and that relates to a potential deceleration in the Eurozone, one that results in a deflationary climate for the Eurozone. There's also geopolitical risk to contend. We deal here with the isolated Russia case example, but it's important to also remember that the Middle East remains for the most part in disarray, and the pockets of volatility there could easily spur into a serious crisis for the world economy. So the key risk that we see for LatAm is that of a risk-off scenario, a return of a risk-off scenario, sort of what we had in October, but a deeper and a more one that generates deeper dislocations across the global economy. So the threats to this, or the triggers to this event, could be either from a Russia-Ukraine crisis, an exacerbation of the Russia-Ukraine crisis, a deflationary spur on the Eurozone, or even the Fed moving to hike rates sooner than anybody expects. So we use all these scenarios as potential triggers to yet another threat to the global economy, and that's being more expansive risk-off scenarios. And as mentioned, this may be triggered by these events that we spoke about, but the implications are quite severe. As noted by this chart, all of these scenarios listed below, it's probably the one that bears the greatest impact on the region, as you have this sharp pullback in liquidity and a migration away from EM assets that would deprive the region of important capital and financing. Thus, the impact on the real economy via subdued growth trends and deeper challenging to policy makers would be quite extensive, as you can see from this chart. And while yes, the important thing to note is that most LatAm economies will eventually be able to export themselves out of this downturn via more competitive currencies, this climate, this threat of renewed risk off developments to the global economy would certainly deal a lethal blow to a region that is already somewhat delicate in terms of its growth potential, and more importantly to a region whose policy maneuverability and flexibility has been somewhat decimated in recent years. So while we still believe LatAm would be able to perform, it's obviously not at the level that they were performing in recent years, and it's because of these past challenges in 2013 and 2014. So we'll take it to the next slide there. And then what we talk about here is trying to detail on the longer-term challenges that we see for LatAm in 2015 and beyond. Now, obviously, the threats and risks stemming from China, the U.S., the threat of excessive geopolitical threats. I think these are all important near-term developments that merit attention. But you're looking at a region that still has to deal with the ability to play catch-up and narrow the gap, or in essence, move up the credit quality curve as it compares to other, to the more advanced economies, and also to even some other emerging markets such as Asia. LatAm has made important strides in recent years in terms of reforms and structural adjustments and competitive gains. But in the past couple of years, and obviously we could probably exclude Mexico and Colombia, little progress has been made, and 2014 has been a year of outright complacency in our view, and 2015 could be the same. The reality is that important structural reforms that aim to bolster capital investment and technological innovations, boost competitiveness, address supply side bottlenecks, improve and strengthen the labor market, all these measures have been lacking. And for all intents and purposes, it's a region that continues to emphasize demand-side measures instead of addressing key supply-side challenges. And the threat is that if these policy measures continue to be ignored, you're going to have steady imbalances across the Latin American macroeconomic space. You'll see very limited efforts to improve long-term factor productivity. And all in all, it would really lead to continued detriment of the outlook. What basically would happen is LatAm will remain a region characterized by uneven growth, deepening inequalities, and segmented societies that for all intents and purposes will really undermine the regional outlook and prospects. So I think these are obviously long-term challenges that need to be addressed, Whether they are addressed in 2015 or not, it will remain to be seen. A number of these countries in the region do have country-specific issues to address in 2015, and that ultimately may weaken the resolve for these longer-term structural adjustments. And getting back to these near-term threats, again, it really all depends how many of these countries adjust and calibrate their economies to really handle these external threats that are so prevalent out in the real economy. So what I want to do now is offer you some brief perspective on the regional market outlook for 2015, and particularly on the investment horizon across the region. This is mainly an endeavor that is comprised in our global macro services products, and one that will see a broader regional coverage in the coming months as we look to expand these efforts and services. So what I'm showing you here is a view on the respective regional, local, and U.S. credit markets. I won't get into the specifics of each country and then the key drivers that are behind our call. Certainly if you have any questions, by all means reach out. But what I want to give what I want to provide is a little flavor of how we see the LatAm markets developing in 2015. We have to remember we're in a climate of rising U.S. bond yields, a strong dollar, and important enough, little efforts by EM central banks to defend their currencies. And the threat of continued volatile liquidity swings are very, very high. You have a very rapidly changing global landscape, a financial market background that speaks to volatility, vulnerability, and country-specific uncertainties. And based on these manifestations, I think across the EMs and certainly in LatAm, we're likely in a climate of deepening differentiation and segregation, and this is a trend that will become more acute in 2015. What this means is that country and credit selection will certainly play a larger role in the search for outperformance this year. And we're of the view that investment positioning across LatAm, primarily the dollar market, or the external markets next year, will not only be driven by headline risk, but also by fundamental risk, political risk, and in some cases, default risk. Across the local market positioning, the underperformance this year has been particularly sharp, but we sense that there are still some opportunities and some plays to capture some real yields. So we're targeting those plays where growth is weak and where monetary policy is probably at this stage set to remain unchanged, or in some cases could turn more supportive. For 2015, we enter with a very broadly neutral position across LatAm, given these vulnerabilities I spoke to you about, primarily with the Fed policy normalization, slower growth mandates, declining commodity prices. But again, there are strong and compelling prospects across some of the more regional hard currency markets, and it's a basically treat with caution approach with caution as we move into the new year. I'm not going to get into any specific calls here. You can see from what we have here in this chart where we stand. But I guess if I have to be pressed to look at the more fundamentally sound credits, we're talking about the likes of Mexico, Colombia, and to a lesser extent Chile. And obviously the more vulnerable positioning stems from the likes of Argentina and Venezuela. And the outlier here, or the one that stands to gain much attention, is probably Brazil, because it's going to be very much dependent on the type of policy manifestations that are implemented by the second mandate of the Rousseff administration. So it's going to be quite an interesting 2015, I would argue, in terms of investment play and market activity. So with that, I will finish here, hoping that Marcos and I provided some important insights and perspective to the LatAm outlook for 2015. And as always, we stand with your comments and your questions. And again, if we can't address your questions here via this webcast, by all means, reach out to us via emails. And with that, thank you very much, and we'll turn it over to the Q&A.
Thank you, Ariam. We have a few questions in already. The first one is, what do you think is the probability that Venezuela defaults on its debt obligations in 2015?
A default in Venezuela, interesting. Look, I think that has been and will continue to be a very prominent theme as we head in 2015, and obviously it stems not only from the macroeconomic imbalances and the distortions you see in the Venezuelan economy, but obviously as a result of the lower oil price trajectory. I think 2015, the probabilities of a default are low. They are certainly dependent on the manifestations of oil prices and very policy dependent. That being said, I sense 2015 they will probably avoid a default. Why is that? First, I sense there will be policies put in place to continue contracting imports. And the most efficient way to do this for them is via devaluation. But we're of the view that we'll probably see a partial devaluation, one not as aggressive as in prior years, because you do have an election coming up in 2015, a legislative election. You do have these festering social pressures across the Venezuelan political climate. Inflation, of course, remains a huge, huge risk for Venezuela. And you have the combination of dual exchange rates, or God knows how many exchange rates now are in Venezuela, but you have various exchange rate mechanisms and capital controls. So I think these are all recipes that suggest that a partial devaluation and not a full-blown devaluation that would obviously be more politically costly will likely be implemented in order to offset these external imbalances that you see in the Venezuelan economy. The other option that they have is to continue drawing down on assets in order to cover this external gap. So you have the opportunity of divestments within Petrocaribe, which is one of their regional oil companies that they manage. You also have the potential divestment of Citgo. There were considerations this year, and in all likelihood, the reason they didn't sell it is because they didn't get a deal for it. There was no one came up to really pony up for it. If not, they would probably sell it. And pressed for hard times as they are right now, I sense they wouldn't hesitate much to really unload it. And the other option is, or there are two options, is they could continue to draw down from these Chinese loans that the Chinese government has been providing, or tap to the BCU gold holdings. And probably even a third option would be that they hike gasoline taxes in order to offset these external gaps. So I think all these measures could be likely in 2015 and should allow Venezuela to avoid a default. Ultimately, look, Maduro and his group of individuals governing the countries may be crazy, but I don't think they're that stupid as to entertain a default, because that would just lead to severe dislocations, a complete shutdown of the global markets for Venezuela, and it's the cost of such a default at this time is prohibitively high for them. So I just don't see that happening in 2015. And like I mentioned, 2016, that's another kettle of fish. I think it'll be mostly dependent if they do implement some important policy adjustments or not, and obviously where the state of oil prices is.
Okay, great. We've got another question in as well. Any thoughts on Argentina's negotiation with holdout creditors? What is assumed in the baseline forecast?
In our baseline forecasts, we really don't give much credit to that. And when we look at Argentina with regards to our forecasts, what really troubles us and really is a huge limitation for us is that we're dealing with data that is not very credible, not very consistent, and subject to unending revisions and adjustments. With regards to the holdout resolution, look, I think if you look at U.S. bonds, Argentine external debt, they're certainly pricing in some kind of resolution in 2015. But really, I think this is a country where negative headline risk remains very, very prominent. And forget about the macroeconomic imbalances and the Model 2 scenario that we're projecting for Argentina this year, but really trying to engage the holdouts in January is probably more likely now than it was several months ago, because you do have the finalization, or the RUFO clause expires in January, so maybe that gives the Argentines a little bit more motive to negotiate with the holdouts. Obviously, you've seen FX reserves, the hemorrhaging of FX reserves stabilize a bit. Maybe you do sense that the Argentines could entertain some mild tweaks and policy adjustments that could further strengthen this momentum to engage with holdouts. It's a touch and go, but really, I don't think the government at this point has a predetermined approach to entertain a dialogue right now, unless really things get really hectic for them in terms of economic challenges and unending FX reserve hemorrhaging and so forth. It's touch and go, really. I don't know what to make of this holdout crisis for Argentina, because it's the unending back and forth. Obviously, Argentina or the Kirchner administration is negotiating from a position of political demands and not really entertaining the country's economic demands and necessities. And then you run into this whole issue with whether the New York judge's decision here in New York will basically open a new kettle of fish with regards to the Me Too clauses and whether all these other investors are going to say, look, we want part of this deal as well. So there's a lot of legal encumbrances that really make for this holdout debtor issues to remain one of great complexity.
Thank you. Another question in, will Brazil's new finance minister be able to avert a sovereign rating downgrade?
I'll take that one, Aaron.
Go ahead.
Yes, I think that the appointment of Mr. Joaquim Levy as finance minister in Brazil last month provides a lot of hope in terms of a policy reorientation, something that Brazil badly needs. I think his first move in office, well, he's not technically in office yet. He's going to start on 1st of January. But the day he was sworn in, he announced a much more credible fiscal target for 2015 and beyond. And he also flirted with the idea of using market expectations for GDP growth into the budget assumptions. So we welcome those views. We think that the fiscal deterioration that took place in 2014 is pretty serious. If you take government deficit in the 3 months to September, just prior to the elections, Brazil spent 10% of GDP. That's pretty serious. The fiscal deficit for the year as a whole is almost 6% of GDP. So the fiscal adjustment is not an option Brazil has to make, and nothing better than appoint a credible, orthodox guy who proved he's able to do that in 2003. So we welcome the return of Mr. Levy to Brasilia, but we remain slightly skeptical on execution capacity, implementation capacity. So far, the targets he set for the primary surplus for the headline key fiscal variable in Brazil are very much in line with our baseline forecasts, but that would also imply lower activity. So Brazil will be able to avert a sovereign ratings downgrade. By that I mean Brazil will avert losing its investment grade status. I wouldn't be surprised if Fitch or Moody's downgrade Brazil a notch further in order to meet what S&P has at the moment, given the bad news we're going to find out as soon as Levy starts working in the 1st of January. But apart from that, debt to GDP should stabilize around 62% of GDP. This is our baseline, and I think the sovereign ratings downgrade, it may come, but not investment grade status. So Brazil will not be junk again unless policy starts to deteriorate again. So that's our baseline view.
Okay, thank you. We've got a couple of questions here on Mexico as well. Can you share some insights on the current situation in Mexico and its potential impact on the real economy and the financial markets? Do recent developments suggest Mexico has a governmental crisis, and do recent events coupled with a still sluggish recovery make Mexico a not so desirable investment destination?
No. So look, I think the current tensions that we see in Mexico, obviously they relate to the disappearance of these 43 students. You have a corruption scandal involving the president's wife. So that really was a key trigger in the outright disgust that we've seen across by the Mexican public with regards to their government. The Mexican public has been somewhat disappointed as a result of these manifestations, but also you have the realization of a recovery that has been considerably sluggish and below expectations. So that's another key factor that is impinging on these heightened social pressures. To a lesser extent, you have the reforms, the structural adjustments, vast adjustments have been made to the economy, and I think the Mexican public was expecting immediate results, and that hasn't been the case. So all these conditions have led for these social pressures. Mexico, however, is not what Colombia was several years ago with their domestic security situation. This is a climate or a domestic security crisis that is very regionalized and is likely to remain so. And I'm of the view that these recent developments, particularly with regards to domestic security, may even give the administration more impetus to implement these security, domestic political adjustments and reforms that are needed, primarily with regards to the judiciary system, to the state of and the role of the police, the national police. So that may be an opportunity. That being said, I think the focus into next year is how these political tensions and the current political environment play out with the midterm elections. You have elections for the governorships of 9 states, plus the local and federal legislation, local and federal elections for 16 states and Mexico City. And the PRI right now, which is the governing party, governs over half of the states in Mexico. So how this impacts the elections is very, very crucial. And you've seen support and popularity rating for the current administration decline excessively in recent months, and obviously for the president, who was once held as a hero, is now obviously support for him has waned. That being said, I do not see a governability crisis. I think if you do have a shift in government, it'll probably be towards the PAN, and the PAN party, obviously the more conservative party, is also the more pro-market, business-friendly party, so it's probably positive in the long end. But no, I don't see a major governability crisis manifesting itself in Mexico. With regards to positioning and investment outlook for Mexico, look, I think we're likely to see added volatility in the coming months, in the near term. You've seen the peso get hit particularly hard. This is likely to continue as long as these social disturbances remain in place, as long as Mexico continues to disappoint on the growth front as they have, and as long as oil price risks remain in the headlines. We're not of the view that these lower oil prices impact Mexico as much as they do other countries such as Colombia. But it's a huge headline risk that undermines the Mexican outlook. That being said, I think when you look at Mexico and compare the country to the rest of the region and to other emerging markets, I think that there's considerable upside momentum for Mexican assets, primarily because it's an economy that is on better economic footing. We do expect the recovery to gain further momentum. We do expect that these reform adjustments will be deepened and will continue to pay off dividends. And ultimately, this is one of the best managed economies in terms of monetary policy, fiscal policy, across the emerging markets and certainly in LatAm. So I think together these manifestations will help Mexican assets on the long term. Near term, more volatility, but we're constructively optimistic on the long term with regards to Mexican assets.
Well, I think that wraps up all the questions for today, and thank you all very much for attending. If you would like further information regarding Oxford Economics, please feel free to get in contact or to visit our website. The recording and the slides will be sent out to you all who registered later on today. Have a good day, and thank you again.
Thank you all. Bye.
Thank you.